welcome to our session, M&A in Perspective, What Drives Value. My name is Mark Roberts. I'm CEO of TechServe Alliance. We're the IT and Engineering Staffing Trade Association in the United States. The M&A issue has been one that is talked about, and we've featured sessions at our conferences and webinars for years. It's one that always draws great interest as folks want to ultimately understand what does it take to drive value for those that are still in the planning stages of an exit. And then ultimately, when you decide to exit, what are the factors involved in valuation? So I'm really pleased to have two phenomenal speakers on this topic and individuals, both of whom I've known deeply experienced in the IT and engineering staffing industry, as well as investment banking and industry analysts. So first is John Larson. He's the founder and principal consultant of Keen Insight Associates. John has been a successful operator, executive, owner who's bought and sold companies. And so he has a really unique perspective, and he's taken on a new venture involved in the M&A space and consulting in that regard, and he'll tell you more about that. And then second, I have Jim Janesky, who's senior advisor of the corporate advisory group at PPAC Private Investment Bank. Jim is just a phenomenally knowledgeable individual who's been around the industry for a very long time, both as an analyst and as an investment banker. I'm not sure. I think yep, there we go. Yeah, that was, sorry for the little technical glitch, but Jim is just phenomenally experienced in the area of M&A with deep experience in a variety of staffing verticals. So Jakob, if you could advance the next slide. So really what, in the short time we have together, we're really going to be providing a primer for how to value staffing firms. Next slide, please. And the question, and as CEO of the National Trade Association, I always get is, what is the multiple? And then if you could advance the slide, please. It seems to be the question that everyone is interested in. But as we'll discuss, it's more than just answering that question. There's so much more that goes into valuing staffing firms than just answering that question. And so we're going to take up a number of those factors. And of course, time is limited. If you advance to the next slide, we're really going to discuss 6 buckets of factors. The first one is financial. If you could just advance the slide. Second, your particular clients, the industries they're in and their profile, your business profile, owners and the team, understanding both the owners currently and intentions later, and then the team that will remain, what your offices look like in terms of footprint, we're going to have some discussion of terms of the deal. And we're also going to discuss the general climate for IT and engineering staffing, as well as staffing broadly in terms of the market for M&A. So with that, I'm really pleased to turn it over to John, who will take us through the first 3 sets of those valuation criteria. John?
Thank you, Mark. I'm going to take a look at the financial piece. We'll break that down. Naturally, that is the one area that everyone is interested in as we look at valuations. Naturally, we're looking at more than just financials, but it's usually the foundation for a potential transaction. As Mark said previously, everybody wants to know, okay, what is the range, et cetera. And it all depends upon, what is the multiple? It depends upon the many factors of which financials one. And I want to preface this a little bit by saying my over 20 years experience is really in the IT staffing realm. So many of the numbers and percentages that I use are predicated on that. I realize that there are many folks on the call that are not necessarily in IT, other types of specialty staffing practices or general practices, or maybe some combination thereof. So a little bit of a caveat based upon my personal experience. From a revenue standpoint, size matters. And I think as importantly, maybe more importantly, when you look at your revenue, or a potential buyer is looking at your revenue, what they want to see is growth. Is there an upward trajectory, to your firm? I mean, you may be a small firm growing very fast. You may be a little bit larger. And when I talk about size and so forth, generally speaking, we see I'll say the very smaller firms in I'll say the 5 million, maybe 7 million size range. Then you get into that 7 to 15 million. So most of what I'm saying on a small firm is less than 15 million. And then when you get to that stage, then it's a mid-sized firm. It's not one of the giants naturally. So revenue growth is a key element, and also the consistency of that revenue. Is it, like I said, is an upward trajectory? Are you bouncing up and down each year? What is causing that to happen? So revenue is a critical component. Your SG&A, as you take a look at that, really that's a determinant of how efficient you are as an organization. How are you able to turn or run your operation effectively and efficiently, so that the majority of that ends up down on the bottom line. And the SG&A also is an indicator of your discipline in running your organization. Are you consistent? Do you have good controls in place? And is money being spent, in the business or on the business that is going to provide your return, or are there funds being used for, I'll say, personal allocations, especially in the smaller firms that have an impact on it? Everyone is interested in gross margins, and we see gross margins anywhere from the high teens to the low 30s. Naturally, a higher gross margin is better than a lower gross margin in general. Here's the caveat on that, or the big but. And I see a number of firms that have lower gross margins, and it may be that they're focused in the VMS world, but guess what? They have an efficient SG&A, or they have an efficient operation, and so their engine still delivers, good profitability. So the fact that you may have lower gross margin percentages in your business, you can still be running a very, very good business. I oftentimes see in that, I'll say the VMO, VMS, MSP world, those margins are going to be in, I'll say, the 18 to 22, low 20% range. And with a retail business, it can be in the high 20s, low 30s as a general rule. The other thing that's going to make a difference potentially is your mix of business, which I'll talk about in a little bit. So just kind of a takeaway, if you look at, the average today is somewhere in the mid 20s, 25, 26, 27% is a good gross margin. Then comes profitability. Many firms struggle when it comes to profitability, and it has to do with the top three items, naturally. If you look at profitability, most companies are going to look, or most buyers are going to look at your EBITDA. What are your earnings before interest, taxes, and depreciation? You might think about it in a simpler way, just what's my net operating profit, before I do any of that. What does it take to run my operation? What's my profitability? Your best of breed firms are going to have profitability at 10% plus. I see many firms, I'll say, in the 3 to 5 to 6% range, and very, very common to see that. The top quartile of firms that TechServe Alliance tracks, they're going to be up in that 9, 10, 11% operating profit number. So it's important that you understand the elements that can impact. And just a small item, if you think about your SG&A and your efficiency of your operation, I read an article or saw a blog a couple of days ago somebody had changed their insurance program, and it was going to save them, like $30,000. It was a lot of work, but that $30,000, it drops right through to profitability. So those are things you should be thinking about in the financial picture. There are others that take place. One item kind of on the total financial picture, you need to make sure that your books are in order. You're going to need at least 3 years, and some buyers can be asking for 5 years. Not only looking back, but also, do you have a forward look on your business? Do you forecast what your business is going to be doing in 2021 or 2022? And it's important, if you do forecast, that, okay, are you meeting those objectives? Are you meeting that forecast? So I think that's about it on financials as a snapshot. Let's go to the next slide. Your clients. We're kind of off the non-financial items, but your clients definitely have an impact on your value and the valuation of your organization. One item to look at is the depth of relationships. What length of time have you been working with a client? Is it a direct relationship or is it hands off? Are you operating in some type of VMS world? And naturally, I think not only the depth of relationship and the length of time, but who's been on that account? Have you had a turnover on, account executives or sales reps on that account? Is it primarily serviced through your recruiting organization or client care organization separate from your salespeople? That's institutional knowledge that is important. I know of one situation. I talked to a sales rep account executive yesterday. He's been on an account for 10 years now. And that, no matter what you say, that has value. He knows the people, he knows the processes, he knows the industry. And as a result, he's creating value for his organization in that process. And I might just comment that that company has been through 2 or 3 ownerships. So even though ownerships change, as far as the relationship to the client, it's remained the same. Level of client concentration. This is always an issue or a challenge, especially with the smaller organizations. So if you look at an organization, I'll say, I hate to use absolutes, but if you have more than 50% of your revenue coming from a single client, you have client concentration. And it could go either way. It could be 30% or 6%, depending upon the potential buyer. I do see many smaller organizations that are in the 60 to 70% range of a single client. Maybe a very large client, but it's still a client concentration, which creates risk. I mentioned risk also. I should have mentioned that back in the financials, because if somebody takes a look at your company, one thing that they're doing is, okay, as they evaluate your financials, as they evaluate your clients, what is the risk profile of your organization? Are the financials stable? As I said, are your clients stable? Do those relationships, is there risk in maintaining, retaining, or potential turnover of a client? So that's reason client concentration is very, very important and something they look at closely. Industry verticals served. And it may be that I would say it's not as much that you should be in specific industry verticals as it is understanding and knowing and having very specific content knowledge around that vertical. And if you've had a client for many years, you should know their processes. You know what their industry is about. You know why you're providing consultants to that particular client and to that particular industry. So that's going to add value to your organization. Let's go to the next slide. Business profile. Really looking at your lines of business. Is it mostly contract? Do you have statement of work? Is it direct hire? Do you have a retained search practice? all of those are going to have an impact. And then kind of one of the large ones that can be divided many different ways is the retail versus the VMS, MSP. In your lines of business, generally speaking, buyers are going to be looking for the contract business. They're going to be looking for contract business. And I think it's preferable in general if those consultants are your W-2 employees as opposed to 1099s, as an example. So a buyer is going to look at that and say, okay, they've got a good book of contract business. In the IT business, generally speaking, it has some runway, whether it's, an average engagement, 6 months, 9 months, whatever it happens to be. So there's some continuity to that revenue, which goes back to the comments on the financial and the risk. I do see a number of organizations that are doing more statement of work. It's an area that a lot of people try, and I think there's some permutations on statement of work today in the marketplace. I see some situations where there are transactions where maybe it's staffing delivered, but it's for a team of individuals. So it's not necessarily a project. It's different than, okay, I'm going to build X, Y, Z and deliver that at the end of the day, as you would in a traditional, software development or hardware development environment. So it may be a business process that is being supported by the staffing company. Direct hire, as many people know, most people know that are owner operators, your direct hire, it's good business when it's there, and it drops to the bottom line at a much higher percentage than your contract does, but it can also disappear very quickly. So while it's good currently, I think buyers are going to take a look at the percentage of contract versus the direct hire. What is the combination? And oftentimes I have seen a discount on direct hire business, especially if there's large fluctuations in it. Some years are better than others. Some organizations, you get a unique situation, and it's kind of a bouncy income stream. Where if it's the last 3 years and it's been 5% or 10% of your business, that's quite different. And then there are a few firms that have a retained search, or there's some firms that are just pure retained search firms. Very different than the direct hire that we traditionally see in the traditional staffing marketplace. There's usually a blend of at least two of these, if not three of those. The retail versus VMS / MSP, and I could add other acronyms on that, the VMOs of the world, and you got a lot of new ones coming on stream nowadays. But in general, you're either a retail provider. You provide your clients with, I'll say, a direct relationship, working with hiring managers, whatever, or you're working with some type of VMS tool or MSP provider. And I think the real key there, in my opinion, is looking at your business profile and how are you set up as an organization. I do not see many, if any, organizations, well, there's some very large ones, but in the smaller mid-sized market, you do retail very well or you do VMS real well. It's not necessarily one is better than the other. You can be successful. I have friends very successful in the VMS world. They've set their organization up to deliver in that space and have done it very, very successfully. I see many firms, the smaller firms especially, that they've been a retail operation for 10, 15, 20 years, and one of their clients goes to VMS, so they try and do the VMS also and treat that like retail. Okay, I got more requirements come in, but the infrastructure is the same, selling's the same, support's the same. Generally speaking, that is not a way to add value to your organization, and you're going to be probably better off from a valuation standpoint in creating value by focused on one or the other, or some new hybrid that's coming on stream. one last comment on here, and that is the one. I'm seeing many new things out there. So this is fairly traditional. I would encourage you to look at some of the, total talent management thoughts out there. And I think we're going to see more movement relative to the offline or remote worker, fractional worker, whatever the case may be that we've heard a lot about earlier today. So with that, I'd like, Jim, why don't you cover the next few slides here?
Could we go to the next slide? Yeah, there we go. Thank you. Yeah, thanks, John. I'm Jim Janesky. I run the business services practice at, as Mark mentioned, PPAC Private Investment Banking. We're part of PPAC Gladstone Bank, based in northern New Jersey, in Bedminster. And we do M&A advisory. We do capital raising, both in the public markets and the private markets. We have a balance sheet where we could do cash flow financing as well. We do sell side M&A primarily, but we also do some buy side M&A. And I do focus on the entire spectrum of the human capital market, whether it's brick and mortar light industrial staffing companies, all the way up to HR technology companies. So some of the comments that I'll make. Am I not on screen?
Jim, we can't see you.
Really?
Yeah.
I don't know how to. I turned on I turned on the.
There's a camera at the bottom.
Yeah. Can you see me now?
Yes.
Okay. But then we lost the slides. Jakob, are you there? We apologize.
There we
Thank
go.
you. Okay.
Yeah.
So I said we focus on the entire human capital spectrum, and I'll be, kind of referring to that specifically at certain points during the presentation. But, as Mark mentioned in the beginning, that's the first question I get as an advisor is, okay, how much can I sell my company for? Oftentimes without even telling me your revenues or your EBITDA. So, that as John explained, as Mark explained, and I'll explain, it's just not all about the multiple. There's a lot of other things involved that you should be aware of. So the first one is the level of involvement by owners, both pre and post sale. Okay. And I would say the first thing, even before you get ready to sell, John alluded to this, is that you have a really solid accounting firm. And if you can, even get your books audited. That makes a difference in the valuation to the buyer. If you have a one-man operation and you're a tiny company, that's fine. But as you get into the 10, 15 million plus range, make sure you have a good mid-sized firm at least. And you should look at a sale, not call up and say, okay, I want to sell my company tomorrow. You should have conversations with folks about it, up to a year, 2 years, 3 years ahead of time. And the first point that I'll make is that the level of involvement depends upon the approach to the process. All right. So if you go with an advisor, such as we are at PPAC, the level of involvement is going to be less than if you try to do it all on your own or with an accounting firm or a legal firm, which you're going to need to bring in anyway as part of the process. And generally, the heavy lifting is done in the end of the process. So in the beginning of the process, and I'm going to talk about the process in a couple of slides more specifically, but in the beginning of the process, we have to gather data from you. We have to get understanding of your competitive situation. We put a large confidential memorandum together as well as a one-page teaser. So there's the heavy lifting in the beginning. And then we do the heavy lifting as your advisor to reach out to buyers that we approve through you. And then at the end of the process, you're going to have to do management meetings. Those used to be in person. Now they're generally done over Zoom. And then the second point is key personnel. Who should you bring on board? only bring those on board necessary to facilitate a sale. That's a decision you should make with you, your advisor, whatever, because this process can lead to turnover if folks find out within your organization that they're being sold. It's disruptive to the business, a lot of water cooler talk. Sometimes it could put pressure on your top line. And then in the end, the deal might not get done. And so you've disrupted the business, potentially caused some turnover. It might hurt your growth trajectory. So only bring those on board. And in the beginning, it's definitely going to be your CFO, because they're going to have to communicate with an advisor such as us about the numbers of the company. Next slide, please. Next is, what is the office footprint that buyers look for? Okay. And first, it's virtual versus physical. Virtual is generally easier to integrate and certainly has become more important post-COVID. What you're doing if you're buying a virtual company, and this happens a lot in the tech and engineering world that John was talking about, they were already set up in many areas, as well as I would say next would be finance and accounting vertical. They were already set up pre-COVID to work virtually. So the revenue pressure on those two industries has been less than it has on other industries where, by their very nature, light industrial is in person. Okay. You're in a manufacturing facility, a warehouse or something. So virtual is easier to integrate. What you're basically doing is buying a customer list. You're buying the recruiters and you're buying the salespeople. Some buyers, however, do want that physical office because they want to expand their geographic footprint. And with respect to a geographic footprint, all else equal, multiple geographies are more attractive and indicative of a larger company. Larger companies, generally get a better multiple. It's lower risk if you have operations in the Northeast and operations in the Southwest. Should one be under pressure for whatever reason, you might be able to make it up in your other geography. A larger company will have a immediate impact on the bottom line results of a company that buys them. They're generally more buttoned up with respect to their financials, which makes them easier to integrate. And then finally, I will add that a larger company is actually easier to acquire than a small company, or less risky to acquire, because you're doing almost the same amount of work and certainly taking on more risk, whether it be from client concentration, recruiter concentration for smaller companies. So it's actually less risky and a higher multiple. That's one of the reasons why larger companies get a higher multiple. Next slide, please. All right, so terms of the deal. Post-COVID, buyers are asking sellers to take on more risk. And when I say more risk, that is staffing companies by their very nature do not have very limited visibility to their revenues, especially on the direct hire side. Okay, so the visibility to those revenues has even become worse, may I say, post-COVID. That's why you should really spend time before you go to market, as John mentioned, with putting together a projection for your company, a 3 to 5 year even projection on your company, well thought out. How can you do coming out of COVID? But the buyers are asking sellers to take on more risk. What is that risk? First, it's the amount of cash at closing. It's always negotiable, but deal terms have changed. So without making an absolute statement, if a certain vertical generally required, or the general principles were that it was 20% down, 20% in an earnout. Now that's moving to 30. 30 is moving more like to 40 or 50%. So earnouts are now, when they once were 1 year for an earnout, now they're 2 to 3 to even more years. And they're longer, and they're, as I just mentioned, a higher percent of the deal post-COVID. That should kind of go back to normal probably over the next year or so. But what's really important, what we always try to do for our clients, is you negotiate upside to the earnout. That means you could, if you are on a good growth trajectory, are confident in your business, you and your advisor should negotiate with the buyer upside to the earnout, so the value of your company potentially even goes higher than what you thought you were going to get based upon the initial cash and then the earnout. So, and what's good about upside to an earnout in this environment is it works best when you're coming out of a slow period, such as a recession, even though the recession was short-lived. But certainly the effect on revenues across the board has been pretty dramatic. If you're coming out of that and you're going to have an acceleration of your revenues over the next few years, the upside could be quite lucrative. Next slide, please. So what's a typical M&A engagement? Okay, if we can go to the next slide, please. This might be hard to see. I think I saw that this presentation will be made available, but there's generally 3 different ways to approach a deal: a preemptive, a targeted auction, and a broad auction. And I'm not going to go through every box on here. I'm just going to point out some of the key points. Okay, so the preemptive is generally 1 to 5, and those buyers might have already approached you. And even with a targeted auction and a broad auction, you may have been approached by preemptive buyers as well. So the advantages of a preemptive is the buyers are generally more serious. Okay, and you know, if you're working with an advisor, you should be able to get fair value for your company. But it does have high execution risk, and it is the shortest in terms of timing to get done. A targeted auction is where we go out and we approach maybe 5 to 10 buyers that I know in the market where you would be a good fit, both profitability wise, cultural, vertical served, etc. So sometimes these are good for smaller companies where we do a targeted auction of maybe 5 to 10. And you know, that generally could get you a better multiple because you are going out to you know, more than just one buyer. What maximizes shareholder value the most, though, is a broad auction. And you know, those are generally for companies, depending upon the EBITDA levels, of certainly 10 million or more in revenues, more likely 15 million more or more in revenues. We reach out to 25. Sometimes I've reached out to upwards of 60 to 70, to 90 different buyers. It is most disruptive because it does take up more of your time in the beginning and the end of the process. But this generally gets you the best multiple, especially if there are multiple bidders on your company. Next slide, please. This is the tailored process or the broad auction that I discussed in the last slide. Okay, so phase 1 generally takes a month to 2 months. You're building the foundation, putting together the book, putting together a selling memorandum, because that's what it is, to attract different buyers. And we'll then open up a data room for you so that when buyers become serious after they put in a letter of intent, they get access to that data room. Then there's the targeted auction where we contact buyers or investors. So there's going to be private equity buyers, and strategic buyers, such as other staffing companies. And we reach out to them. It generally takes another 2 to 3 months in the process to get to start initial conversations, follow-up conversations, and then management meetings, and finally to solicit and negotiate letters of intent. Phase 3 is closing the deal, and that's where you select the party, execute the LOI, and sign and close the deal. Let me go back for a second. So that is how long it takes to close the deal for a more targeted auction, I should say. With the tailored process, it's going to take more like 5 to 8 months. Okay, so the first one is going to take anywhere from, 3, 4, maybe 5 months. This one's going to take 5 to 8 months, and that's where we're going to reach out to the 25 plus buyers, similar to how we do in a targeted auction, but it's a much broader group to attract a much better audience and hopefully get you a better valuation. And terms of the deal are just important as the valuation as well, especially with respect to private equity firms. Next slide, please. So what is the current M&A market? Here's where we talk about multiples, okay? So generally, the M&A market in staffing has rebounded in the United States from pre-COVID levels. Again, with buyers asking sellers to take on more risk. So generally, if you're a light industrial company, it's anywhere from 2 to 5 times EBITDA. If you're a professional company, IT, healthcare, engineering, more in the 5 to 7 range. And then that 7+ range is really reserved for those really special companies that John alluded to, low customer concentration, bigger than 15 million, great revenue trajectory over past several years and looking forward, great profitability that has the opportunity to expand over time, especially as part of another organization. Which verticals do you serve, et cetera, or which geography that you serve. So that will all depend upon a number of different factors. In the United States, we've gone back to an environment where there's more buyers than sellers. The market did take a pause in the kind of summer to fall time frame, picked up at the end of the year, and has become very active as we enter 2021. U.S. multiples have rebounded to the levels that I just explained. Access to financing is still very good at low rates. So if you're a strategic buyer, even before COVID, the economic expansion was getting long in the tooth, right? It was the longest expansion in the history of the country. Through other means. Private equity firms, the worst thing that they can do for their investors is keep their money in cash and not put it to use in investments. And there's still plenty out there. So there would be, there's always there would be, depending upon the again, your company and what vertical you're in, et cetera. I think there would be a lot of interested parties, and there are a lot of interested parties when we go to market with the company. In the international market, I would say they're probably 1 to 2 quarters behind the U.S. in terms of growth. U.S. got PPP loans. That really helped the distressed market for staffing companies. In the beginning, as we were going through the PPP process, I thought that there would be more distressed companies, but PPP really helped, and now there's a second round that just opened up this week. So in the international market, distressed companies are still more the focus there, but that should rebound as well over the next couple of quarters. Thanks.
All right, let's continue on. Let's go to the next slide. I'll do the next couple of slides before I turn it back over to Mark. We've got about 15 minutes or less left here, Mark, so we'll move through this pretty quickly.
Yep.
In disclosure, I am on the board of directors of TechServe Alliance, where Mark serves as the CEO. And TechServe has created a new service offering. It's a mergers and acquisition marketplace. And it's really a different approach for buyers and sellers of firms under 15 million in revenue. So this is designed, I'll say, for the smaller firm that may not be in a situation where they could avail themselves of all the services that Jim previously mentioned. So it may be it's just a kind of a different process. And the objective of the offering is to have that smaller firm, as Jim said, there are more buyers out there than there are sellers. And the small firm, this is probably their only time or first time that they've looked at selling their company. And so they really have there's many unknowns in that process, because it can become very, very complex. Let's go to the next slide and kind of tells why TechServe created this. It really creates a marketplace where one doesn't exist. Your larger strategic firms and definitely your private equity, the small organizations, the small companies in the staffing industry, quite frankly, they can't move the needle. The fundamental financials aren't large enough, whether it's the revenue or whether it's the EBITDA amount. It's just not large enough to provide the return that somebody's looking for. And Jim made the comment, and he's correct in that it takes as much effort to do a big deal or a small deal as it does a big deal. It may not be 100%, but it sure isn't relative to size. If I'm a $5 million company or 10 million, and I'm 100 million, it's not 10% of the effort. You still have to go through the due diligence effort. And so really, this has created an opportunity for those smaller organizations that have a difficult time getting to market. Retains their ability to maintain confidentiality by working with TechServe in this situation. Now we see the small firm, if they want to go to market, they may talk to an advisor, but oftentimes it's okay. Who do they know? Who have they met at a local function of some sort? And so it's very difficult for them to expand the potential buyers for their business, as Jim mentioned earlier. Usually it's just, okay, it's one, or maybe it's two, but okay, how do they attract 5 buyers or 10 buyers or more? So it provides them an opportunity to kind of test the waters, maintain confidentiality, which is very, very critical in the early stages, as Jim mentioned earlier. Who is aware of this? TechServe also believes that overcomes some of the challenges of both the buyer and the sellers. Because in the market today, let's take the seller side of it. Sellers are unsure. I said earlier, they don't necessarily know what they don't know. Naturally, I want to sell my business. I'm looking for, what's the multiple? Back to the original question, nearly an hour ago, what's the multiple? And then I'll figure out. Well, I have seen numerous situations where they engage and they may go through, a month or 2 months of work and then figure out, no, I really don't want to sell. I might as well just keep doing what I'm doing. I've been doing it for 15 years and I'm making a good living, and I'm going to do that. So as a result, they've invested time and energy, and the potential buyer has invested time and energy, which it all comes for naught. And the seller, in this new offering that TechServe has, they're asking the seller to go through a process under NDA to look at the valuation of their company and to look at the business operations of the company. And really, it's nearly up to I won't call it a due diligence, but it really a deep dive into their business operation. because we know what a buyer is going to be looking for. So we want to be able to say to the buyer community, TechServe says, okay, to the buyer community, here's a small company. They've been vetted. Here's what's been done up to this stage. We know they want to sell, et cetera, et cetera. Their financials in order. They have a good awareness of what's going to be required from a due diligence standpoint. They've got a lot of that stuff ready to go. Now we realize that the buyer is going to have specifics and they're doing their own due diligence and everything else. So we totally understand that. But at least the buyer has a level of confidence that, okay, when I talk to this small company, they're going to be ready to go. They've already made that decision that I'm going to go into the marketplace and I'm going to entertain, a viable offer. So TechServe believes that it reduces the risk for both the buyer and the seller in going through that. And potentially there's a potentially transaction cost may be somewhat less. So that varies across the board, but there's an investment required, whether it's in a traditional go-to-market process or even if it's with TechServe. There's an investment that individuals have to make to say, okay, I'm serious about moving forward with a potential transaction. So there are many more specifics behind that. There's a full program that TechServe has. So feel free to contact TechServe or Mark or myself and be glad to go through any of the details that you need. So with that, I think we're going to turn it back over to you, Mark. That's as far as complete for now.
Great. Thank you so much, John. And so up on this slide, you have my contact information, John's and Jim's. And so certainly if you have follow-up questions, so we're happy to take a few questions. We have a few minutes. I thought Jim and John did a great job tackling a complex topic in a brief period of time. So feel free to post a question in the chat. As a matter of fact, there's one question, Jim, I don't know if you want to take a shot at it. Someone's asking, what's the multiple? So it's that very question we asked up front for mainly a small company. I don't see if you see that chat. You want to weigh in on that?
Well, yeah, there is so many chats coming through. I didn't see a small company. Did they say the revenues or EBITDA?
No, a small company, but client concentration, 60%. What would the multiple be? 7 million.
It depends, right? That's the classic investment banker answer.
And my joke is the only person who says it depends more than lawyers are investment bankers. In true to form, Jim, you delivered.
60% customer concentration is only natural for a smaller company, right? I mean, do we lose Mark? But 60% is very high, and generally, depending upon what industry you're in, you're going to get the lower end of the ranges that I explained. Certainly, John might have mentioned 50% customer concentration. We like to see less than 25%, but understand that with smaller companies, that is going to be more difficult.
Hey, Jim, I'm going to take a stab at this because I get the question all the time, just like Mark does. What is the multiple? And in this situation, the comment was made. It's a $7 million company, revenue-wise, I'm sure, and a 60% client concentration. And my personal opinion is that's probably not knowing what the bottom line looks like. That does have a bearing on it, but I'd be somewhere in the 3 to 5 times multiple. Naturally, a lot of different aspects to that, but it's going to be on the lower range.
That's in IT, John. But if you're a light industrial company, it's more like 2.
I would agree with yes.
Yeah. Yep.
I agree with that.
I agree with you for IT and engineering companies, sure.
So and I got back in, but so there were a few other questions, and certainly feel free to add some questions to the chat. But maybe if Jim and John, if you take a stab at this, how have you thought that valuations have been impacted by the pandemic. Jim, you alluded to it. You think we're back. Is that your take?
Well, yeah, I mean, in the staffing industry, there was more like a freeze than a decline.
Mm-hmm.
Okay. There was a freeze because buyers weren't sure what they should pay for a business that might be is my business going to go down 20% during COVID? Is it going to go down 50%? And with the lack of visibility with respect to revenues in general, as I mentioned in the staffing industry, it took more of a freeze than absolute pressure. And those multiples have come back to the ranges that John and I discussed for good quality companies, Mark.
Okay. And John, what's your take?
I think there's been some impact, but I think it's short-lived. Longer term, I would probably agree with Jim in that the multiples are kind of back. Maybe they just took a pause. Many staffing companies out there are growing this year. They may have had 1 or 2 quarters, but you can absolutely explain that. And part of that goes back to the financial picture and the risk analysis and the quality of earnings. That's what a company's going to take a look at. And if I'm down a quarter, okay, why? Can I explain that? Or I'm down 2 quarters and I'm back up. So I would agree with Jim that the fundamentals of the financials and the business operation are still going to be the driving force behind that. And I don't think it's moved the multiples in a downward fashion at all.
And John and Mark, when you look at the publicly traded staffing human capital companies overall, the stock market is 4 to 6 months forward looking, and it's telling us their stocks took a hit like the rest of the market and have come back very nicely since then, and they're doing deals as well for cash and stock in the market. So the market's telling us through the staffing stocks that the next year or so, 6 months to a year, is going to be pretty good for the staffing industry.
So here's a question: What impact does the profitability of the customer base have? If they're a highly profitable customer base. John, you want to take that one first?
Not quite sure I understand when they say a high profitability. Is that from a consulting standpoint?
No, I think their customers are highly profitable versus.
I don't know if that has a bearing on it unless it translates into my bottom line as a staffing provider for that organization. The fact they may be highly profitable, can I convert that or some portion of that, to my, gross margin percentage and eventually my EBITDA? Jim?
Well, larger, on the other hand, larger, that's a great point, John. I don't think it really matters one way or the other. It's what you do with it. But, larger companies, more profitable companies generally have more sophisticated ways of, or go through VMS or MSPs, right? And so there's a kind of a double-edged sword there, but it really shouldn't matter to you. It's like you said, what do you do with it?
So what's your take on whether we're seeing a consolidation within the staffing industry? That's always a hard one to measure because there's always entrants and those that are leaving. But what's your take on it?
It's been consolidating for years, Mark, and it will continue to consolidate. I am talking to owners, CEOs who are, were maybe not thinking of selling pre-COVID, but are now just sick of it. Okay. And are just waiting for their revenue trajectory to recover on a more consistent basis and their profitability. And so I think we're going to see increased consolidation throughout 2021 and beyond.
Yeah, I would agree with that. But another view of that, Mark, is that there used to be, and still maybe today, there's a low barrier of entry to start a staffing company. I think that's going to increase. I think the sophistication of even the small organizations is going to have to be enhanced to provide, more value-added services, in order to really support their clients going forward. we're seeing so many new tools and opportunities out there. I think the staffing industry is going to continue to morph. Will that create some consolidation? Yes. I don't think we'll have as many coming in on the bottom end as, okay, I'm a great salesperson. I go out with a great recruiter and I start a staffing organization like you could do, 15, 20 years ago. So just another view there.
Great perspective. Well, I know we're nearing the end of our time. There were a few questions we didn't get to. But first, I just want to thank Gustav, Jan Jakob for hosting us, and Jim and John, thanks for doing a great job on an important topic. You have everyone's contact information. If we didn't get your question, I know both Jim and John would be happy to field questions, as would I. So really enjoy everyone. Thank you for everyone who participated, and I'll look forward to speaking with you again soon.
Thank you very much.
Thanks, John.
Appreciate it. Thanks, Jim. Bye.
Bye.